Welcome. I'm Thomas Solangi, the firm's national manufacturing leader, and welcome to our final part in our four-part series of our manufacturing outlook, taking sustainability to the next level. We're going to have an exciting panel discussion today. But before we get into that, we hope that you found the last three parts very informative. I thought, the Fed Reserve overall was a little more, it was pretty optimistic. So that is very good to hear that we are seeing a nice rebound. Hopefully we don't see a pullback here with less stimulus and COVID rising again. But overall, and then Thomas Stewart, how about what's been keeping manufacturers up at night, but also the opportunities that we're seeing in reshoring. So there's some excellent opportunities there. And finally, our part three, pretty exciting, Biden-Trump differences in how the supply chain is going to be impacted. And if you weren't able to be on any of those parts, please let us know, and we can get access to you to be able to view those. But next, I want to introduce our panel. Today, we have Ryan Greenawalt he's chairman and CEO of Alta Equipment. Alta is really a great source for material handling and construction equipment. We're going to hear about an exciting story, how this middle market company became public, and a real opportunity for many manufacturers that they maybe wouldn't think about. Also, we have today Josh Schultz, managing partner at Greenlight Growth Partners. We're excited to have Josh on today. Josh is an investment firm that makes control equity investments within the automotive industry. Next, we have Blake Kenny. Blake is a managing director at Great Rock Capital Partners. They're responsible for deal flow anywhere from 5 million to 100 million. Great is an asset-based lender, providing growth capital, acquisition capital, and also in event of restructuring. And last but not least, we'd like to really welcome and thank Steve McCarty, our national CEO, who is going to moderate our session this morning. So I'd like to welcome Steve McCarty. I'm going to turn it over to you. But first, don't forget again, if you have questions on your control panel on your right side, please go ahead and answer any questions for our panel, and we will likely answer those as we're going through or at the end of the session. So thank you, and Steve, I'm going to turn it over to you.
Thank you, Tom, and I really appreciate you organizing, all four of these events. There's a tremendous amount of work that goes into making this happen, and between you and Jessica, you did a great job. So thank you for that. This session is going to be different than the other ones that you've seen or joined. There's going to be no hard to read graphs or anything like that. Rather, it's really going to be robust discussion, with people that are actually driving growth every day for middle market businesses. And as Tom knows, accelerating growth and creating, real wealth for generations to come are things that we're really passionate about. So there's just a few years ago, we sold a business to a private company to Scotts Miracle-Gro, a publicly traded business. And so it was a big transaction in that public space. And the owner told me after the sale that had he met me 20 years earlier, he could have compressed what took him 20 years to do into 5. And so that's a little bit of the inspiration that I hope you'll get from talking to these great panelists today, is to think about things that you might be able to do with your business. So to our panelists on the webinar today, we've got a lot of great lifestyle businesses. We've got some multi-generational businesses, and we've got some organizations that are really transforming into institutional brands. And to our guests, as Tom said, please submit questions. I've got some that I've prepared to try to stump our panel as best I can, but we're not going to go more than an hour, so submit your questions along the way and we'll try to address them as we go. So Tom, I think I'd actually like to make sense to go to you just for the first one here. Can you maybe share with us some strategies that you're seeing companies take when they're thinking about sustainability and growth?
Yeah, obviously that's a, perfect question, obviously, that it helps set the stage for this panel. And it's something that's been thinking about and talking about for many years, actually. And we've been seeing the shift in our middle market companies where, a lot of them are, potentially selling. And, why is it? Why is there such a dramatic shift when we look back? And why do we think it's so important for some of these smaller middle market companies really look at what's going to drive sustainability and take them to the next level? And let's first look at the challenges that has faced, our middle market companies. We had rising labor costs, right? A very tight labor market over these past many years that has really been a strain on smaller middle market companies. Look at the rise in baby boomers, right? We got rising baby boomers. We have global competition that's been probably one of the biggest factors in the last decade that has really transformed business, right? And put pressure on profits. And then a growing trend, obviously, in innovation, in technology, and how would certain manufacturing companies be able to change and adapt to that? Is we've been talking about that for the last 4 or 5 years at our manufacturing outlooks, and it's been a big risk because it's a change and a shift in the workforce that's really that they need, but also what are some other opportunities that we see, right, that have really transformed the market with a low cost of capital, right? Historically low capital gains rates. It's been very opportunistic for either selling or buying. We've had investors that are kind of tired of the very volatile stock market, right? Looking for other ways to invest, which there's a lot of dry powder out there. We have tried to combat many of these through lean manufacturing and all kinds of techniques to, preserve profits and still be able to grow. And today, you look at, another reason is a pandemic. Look what that's done. And many companies have the opportunity to grow, but now are struggling to even get their own employees to come back because they're fighting against, the unemployment supplement. So a lot of different forces. So how do we look at this? How do we look at some of the key strategies to really go forward, to help your business move forward? Develop a written strategy. It sounds cliche, and everyone's saying, "Oh yeah, I know my strategy. It's in my head," But how do you really plan for that? We have a team that really can help develop that plan because it's critical. Because these are major, major investments and life-changing events. So can you buy scale? Are you gonna build scale? Do you go vertical? Do you go horizontal in your supply base? Is it a way to buy talent, right? And we're gonna talk with Josh, is a PE a potential route really to expand your business, grow your business, and take it to the next level? We really think so. And we have Blake here really talking about the importance of a strong balance sheet, the ability to attract capital, leverage your balance sheet to grow is critical. And then can't say the rise in the SPAC market, the special purpose acquisition companies. We are just seeing explosive growth. These are companies that, and Ryan's going to go into it on a reverse merger, that are really impacting the middle market. So it's really, really exciting. And then also, something we've obviously been talking about, and won't talk about as much today, is really that drive to innovation and technology is something that is critical to drive sustainability. And also, potentially, the employee stock ownership plans. Those could become, we've been seeing a little bit of resurgence in that area too, to drive sustainability. So we won't talk about, that's a whole topic by itself. But again, these are some of the strategies that we're going to talk about in today's panel. And I really look forward to hearing everyone's perspective.
That's a great point, Tom, you made about the number of SPACs that we're seeing out there. And I think if you go back just 12, 15 years, the number of SEC registrants declined every year. but because of this robust stock market, we've seen an unprecedented number of public companies and people filing, and I think we're going to continue to see that. Ryan, I've had the pleasure of watching you transform this business and really grow it and ultimately take it public, which has just been an awesome journey for you. And maybe would you share with our audience here a little bit about your experience and the considerations that you thought of when you were making these tough decisions to go to the public markets?
Sure. Thanks, Steve. And, I think of Alta's history as having chapters. And so this latest chapter is public. But prior to this, we had about a 2.5 year, or not quite 2.5 years span where we had a mezz investment, mezz debt. And so, that having the right capital structure and the right partners, capital partners, is important to accelerate the growth. My story is I returned to a family business 12 years ago that was in the state of Michigan. It was really only a forklift dealership. We had one brand of lift trucks and had become the dominant supplier of material handling equipment in Michigan. And I returned to the business from a career in financial services and spent all that time in San Francisco on the West Coast. And one of the sister dealerships that I saw was a third generation family business on the West Coast that had entered new verticals. They were in over-the-road trucks. They were in agricultural equipment, forestry equipment, construction equipment. And it kind of it sparked an interest in coming back into the industry, into the family business, and gave me a sort of this roadmap for what Alta could be. And so I set out really to grow the company regionally and to expand into new verticals. And what has really been exciting is that the strategy was to do that, but the reality of what's happening in the marketplace has accelerated that. There's as you spoke earlier, there's a trend towards the entrepreneurs wanting to exit the business. A lot of these businesses are owned by entrepreneurs who are approaching retirement age, and some of the tools of the past of passing the businesses to management or to family members, as the companies get bigger, as they become more sophisticated needs in terms of technology and financing. Some of these family businesses are ready to kind of exit the picture, and it's been a big part of our growth. We have alignment with our 2 OEM partners. On the forklift side, it's Hyster-Yale is the biggest partner. On our heavy equipment side, it's Volvo Construction Equipment. And there's a trend towards consolidation in our industry. You're seeing it with in the competitive landscape as well. The manufacturers want well-capitalized, professionally run dealers. And a big part of going public was to have the right capital structure at the right time. And we've done 6 deals this year, inclusive of, we're working on closing one over the weekend. But this has been an unprecedented time of M&A activity for us, and it's kind of, think of it as we're at the starting gate, not the finish line. Now that we have this capital structure, we have alignment with our OEM partners, we're going to continue to do this. So it's been a lot of fun. It's been an interesting time to learn to be a public company CEO. Right in the midst of a global pandemic, we had our first earnings call after the pandemic had started. The market was sliding, our revenue was sliding, but in a way it was a silver lining, because it gave us an opportunity to test the model and show the dexterity of the business model and how it holds up in a recession, albeit a brief one. It was a deep one, and we had an opportunity to show kind of how we navigate troubled waters. So excited about where we're at. We've got a lot of irons in the fire just in terms of future growth, and happy to answer any questions about the financing that we did to go public, or the previous chapter where we made the decision. I brought in sub debt and bought out the family now 3 years ago was the previous iteration. So thanks, Steve.
I like the way you kind of address that as chapters in a book. And yeah, I mean, I think time flies, but you've been very methodical in your approach and very deliberate. And I think it's incredible to see what you've built today, and I'm excited to see where you're going, because I know you're not stopping. So that's a really fun thing, and maybe we'll check back in a minute just to talk a little bit about how you're using some of that capital too. Josh, but I think so we have an opportunity to go public, and maybe something we see an awful lot in the middle market lately. It seems like when I came into this public accounting business 30 years ago, it was all entrepreneurs and second generation and third generation. And now it just seems like the world's turning into private equity sometimes. There just seems to be more and more private equity sponsors taking minority positions, taking control positions, just acquiring middle market businesses, platform acquisitions. So can you maybe share with our audience today a little bit about how private equity sponsors try to partner with middle market businesses to perhaps accelerate growth?
Yeah, thanks, Steve. Yeah, really, private equity, I'd say, comes in a lot of different shapes and sizes, right? Kind of whereas we're at Greenlight very sector focused. We only do control acquisitions, and then we have a capital base that's different than most, whereas most are institutional capital bases, and we really kind of align with high net worth families, ultra high net worth families to fund our transactions, which we view there's benefit kind of that sector specificity, and kind of also having investors that for the most part have owned and operated business in our sectors to really leverage from a kind of an investment evaluation perspective. We can be more thoughtful than some of our counterparts, for instance, and then also from kind of managing and controlling these businesses. So kind of aside from some of the nuances, the differences maybe, what private equity really brings is a different model to business ownership than what typically is occurring from a family-owned business that maybe it's a lifestyle business, maybe it's not, but at the end of the day, if a business has 10 million of EBITDA, maybe 15 of EBITDA, that family's view of wealth is really going to likely lean more towards wealth preservation than wealth creation, right? They've kind of gotten to the point of wealth creation. They're taking dividends out. Maybe they're spending time in Florida, right? It's to take the business to the next level, to really double the size of the business, for instance, which a private equity firm kind of needs to do to stay in business. A family-owned business is going to just take a different kind of set of risks than what private equity is willing to do. Now, I would say they're calculated risks, they're thoughtful, and kind of having owned and operated a lot of businesses, right? I would say that these firms have a nice job of navigating some of those circumstances. But for a family to really decide, are we going to bet the farm on kind of trying to get to that next level and potentially screw things up for generations to come, it's a much different kind of decision-making process than when private equity comes in. And I really think there's kind of tried and true methods of private equity firms coming in, setting aspirational goals, kind of aligning incentives with management, and then giving the tools and the resources to kind of help facilitate that growth and really achieve those aspirational goals. So I would say it's there's a lot of different options for business owners, and kind of the private equity approach could be a 100% sale, kind of hand the keys off and let somebody else take the business to the next level, or kind of do what they're going to do with the business. But then there's also, you mentioned minority stakes, maybe less than 100% control stakes, where you're really choosing to partner with someone and hopefully leveraging their resources, their capabilities. And in doing so, you've taken some chips off the table. So no longer are you betting, the entirety of the farm, maybe a portion of the farm going forward, but you're aligning with someone that you trust and that you think is going to give you some additional tools and resources to take that business to the next level.
Well, it's a great point. And I think, back in the day, people always thought private equity would come in and break up a business and sell off pieces. And that's not it at all. And, I've seen countless examples of, great private equity transactions where people talk about the second bite of the apple being juicy, and it is. I think when it's done right and executed, and you pick the right financial sponsor and partner, you can really accelerate growth dramatically. Thank you for that. Blake, maybe you can talk to us a little bit, first of all, a little bit about Great Rock, but in your what you do at Great Rock, and certainly in your background in the senior banking space, can you maybe tell us a little bit about what trends you're seeing right now, in the commercial markets with respect to this COVID pandemic that we're in, and how it might affect the growth of middle market businesses too.
Yeah, thanks, Steve and Tom. It's always a great event. I look forward to it. Look forward to doing this and seeing you guys in person next year. But you've done an awesome job in the past week. Yeah, we're a non-regulated lender. A lot of names for us now: private debt group, commercial, private debt firm, commercial finance company. At the end of the day, we're lending out private capital. Our focus is generally family-held businesses. We're a little bit inverse at Great Rock than probably most of the market. A lot of the private debt firms in the past 5 years that have grown have been 100% focused on PE. We also focus on PE, but for the most part, our bread and butter has been family-owned businesses. We have two large institutional investors. One is PIMCO. The other is a group called Sightway out of New York. Both good-sized groups. I would say there's been so much talk lately about lenders and our unbashful pullback from extending new credit to hospitality, think travel, all things, aerospace, oil and gas, commercial real estate. And so there's been a lot of chatter on that. I'm going to actually focus on 7 less kind of discussed trends that I've seen, and they're counter to what we've expected. Post financial crisis, bankers started using these automated risk rating systems. They looked back 12 to 24 months. These became obsolete, or I should say somewhat obsolete, almost overnight. Bankers are now actually sitting back down again, pre-financial crisis style, I say. So they're making human decisions again, and they're determining companies' resilience and sort of their ability to weather this crisis, which I think personally is really good to see. It's a positive trend. And banks are also being gentle. We're not seeing a lot of bank kick out, moves to work out. And I mean, absolutely no offense to traditional banks on this, but I think the market was kind of betting against you guys, thinking that the trend was going to be kind of much harsher. But I think it's also another positive trend. Market has remained really, really pretty competitive. There's been a low inventory of quality deals. So the ones that have surfaced, there's been a lot of competition around. We are seeing a lot of different sources of competition during COVID. I think a lot of it, like here's a great example. We effectively lost a deal to the German government a few weeks back. They backstopped a facility in Europe, and the money flowed to the US, and so, kind of no longer needed. So that was unusual. But we've also seen, so the deal process and the quality of info is actually, the deal process is slowed, I should say. Quality of info has dropped a little bit. I think working from home is a bit of a factor. If it's not directly, then it could be indirectly. All things considered, I think the country is still doing a really good job operating in this environment. Asset valuations, we haven't seen a huge dramatic downward change in that. I think other than outside the obvious industries. Granted, not a lot of auctions taking place in the market right now, but lenders are really trying to work through this difficult time with clients. So a bit of a positive trend there as well. Last thing that I know that management on this call does not want to hear at the moment, but market risk has increased, and so we are definitely seeing return expectations from lenders increase, especially with the forward-looking, low yield or low rate environment, low yield. So the absolute most common trend I think right now that we're seeing as lenders is there's definitely challenges to lend incremental additional capital, getting it out the door. There's so much uncertainty in the market right now that I think that's generally been difficult in the industry. I'll put in a quick marketing plug for Great Rock. We've been really fortunate to have gotten a fair amount of capital out the door during this time, and have got a pretty robust backlog in underwriting. So, kind of a good segue to capital strategies. Just hitting on this really quickly. Tom Stewart from the National Center for Middle Market last week. I think I heard him say, 2 really interesting things. One, private equity is actually outperforming their peers, and 2, I love the term that he kind of coined. Tom, I know you picked up on this, but immune system. So the corporate immune system, he said that there was a real, a company's ability to access capital was a huge portion of helping to drive growth and get through the pandemic here. So my personal opinion, I think the PE outperformance is largely in part to companies and their ability to approach the capital spectrum. I think of banks on one hand, very low risk, but very low return. On the other hand, you've got, pure equity where infinite downside, infinite upside. Ryan, you just touched on accessing sub debt. So I think guys like Josh, you're the masters of filling out the cap stack and balancing between risk and return with regard to leverage. So to wrap it up, I think it's definitely worth spending time learning more about your options in that capital spectrum. Unlike Great Rock, there's not a ton of firms out there that focus on privately held businesses. Sorry, that's my second marketing plug for the day. But I would highly suggest that you strategize with UHY professionals around you to look at that capital spectrum, pick and pull different pieces out of it, work with various different lenders and or private equity and or go public to fuel growth into the future.
There's no doubt our senior banking friends have been just slammed with PPP loans early in the year and now wrestling over the Main Street program, which doesn't seem to be as opportunistic perhaps. And we're going to be entering maybe the forgiveness phase or another round. So, but definitely seeing a lot of clients take advantage of these incredibly low rates and beginning to stretch debt. Josh had a question come in here about the average time frame for seeking a PE partner or the sale of an industrial company and completing that partnership or sale. So maybe your thoughts on timeline, and then I'll give you my thoughts on timeline.
Yeah, so this is timeline kind of to consummate the transaction and enter into the partnership.
Yeah.
Yeah, I would say, from the time you hit go and start to have conversations with potential partners, potential buyers, purchasers, it's really, I would say you should consider it to be a 6-month process. It can be done quicker than that, but to really be thoughtful and kind of given that this is a once in a lifetime event for most business owners, kind of that vetting process is highly critical, right? If your intention is 100% sale, maximize value, don't care who's going to own the business the day after closing, I think you can race through a transaction, but to really pick the right partner, from the and there's a lot of prep work that has to go into this before kind of having the first conversations with potential partners. But I would say kind of from meeting with those partners to getting to a closing, you should consider 6 months.
Yeah, and I would probably just bolt onto the front end of that when you talk about the preparation. That's where I think we see a lot of businesses that maybe run a little bit like a checkbook business where they run some personal things through the business, or our mission is to try to identify those add backs, those things that really didn't contribute to EBITDA, so that we can normalize that. We're normalizing COVID impacts right now, and our plug, Blake, will be that our corporate finance team actually has closed 7 deals during the pandemic. So deals are still getting done, and they're all premium deals. They weren't distressed deals at all. So, but it does take time to make sure you have audited financial statements and you get in front of a transaction. So.
Yeah, Steve, to your point, I would say that the number one factor in a successful transaction is that preparation. And, I don't believe that sellers are flippant about kind of what the process looks like, but it is a little bit of, they don't know what they don't know, right? Most business owners will go through one of these transactions in their lifetime, and they're dealing with counterparties that do transactions for a living. So there's a set of expectations. There's, kind of the old adage of you get one shot to make a first impression, but there's a lot of capital sitting on the sidelines. There's a lot of opportunities to make investments, and kind of, if you find the right partner, kind of having those initial really good meetings such that that partner doesn't move on to a different opportunity, and it's hard to kind of reel that partner back in. So kind of that upfront prep, aligning with folks at UHY, kind of good legal counsel that really levels the playing field. There's no one that's ever going to know more about the business than the business owner or the management team. But how do you package that into a manner that buyers are accustomed to seeing? Kind of, how do you transform that vision and all those thoughts up in the owner or the management group's head into a fashion that is relatable, can be distilled, and kind of is tangible to a buyer, and they truly understand and can kind of get on board with that vision and that strategy for the future.
Thank you for that. And the good news is we're getting some questions rolling in here. So Ryan got one that's asking about since you've gone public, do you feel that it's given you the resources you need in order to help you grow? So this might be talking about a chapter or two down the road, but thoughts on that?
So absolutely, the capital structure and the liquidity, and what I think of as more of a permanent funding source where, if we need more equity, we have now a function to be able to raise equity in the business. It is absolutely going to accelerate the growth. One of the differences, and I think the chapter where we had the mezz debt, was quasi private equity. There was warrant coverage on the business, and they were very much our capital partners. It prepared us for the going public. That we doing what we did in going public in 6 months through the reverse merger would have been nearly impossible had we not had that 2 years of runway of professionalizing our back office and establishing an advisory board that now is a real independent board of directors. So for us, this is the next chapter, and it's the right structure at the right time to continue to accelerate the growth. And absolutely, the answer to that is yes. My previous background, I was in financial services. I was in the wealth management side of the business, and so some of the market-facing parts of the job, the talking about the business, the talking to analysts, and the earnings calls, that part of it I actually enjoy, and that's part of what a lot of public company CEOs dread. So that it's been fun so far, even despite the pandemic and the conditions we're operating in. So yeah, excited for the future. We did the right thing.
That's awesome. That's awesome. Tom, the election's just around the corner, and it seems like every conversation we have with a client is, the what if, what do I look like on April 15th if this or this? And I think there's also a little bit of a longer term view that we have to think about when we're talking about accelerating growth. So do you want to share a little bit about your thoughts on, the difference in the, with this election around the corner and how it may impact, growth strategies that middle market businesses face?
Yeah, don't panic just yet. But we will certainly be having a full webinar once the election is over and we have a clear outlook of what's going to happen truly in the tax environment. But when you look at it, there's a few things. Obviously, I will say that's under a Biden win that we really are looking at hard with clients that potential estate planning is going to be a bigger issue here with the changes there. Is it pulling ahead income into 2020? You look at the potential additional tax on wages greater than 400,000, which is 12.4%, the employer and the employee side. So a lot of those entities that are set up as operating entities that are set up as LLCs are going to have a pretty big hit and may need to look at how they're structured. But I'd say most importantly, this is I would say the number one item that could really impact growth in the deal market if this comes true is the capital gains going to ordinary rates greater than $1 million. So you can figure, you're selling your business, most deals are greater than $1 million. I mean, that just changed the deal market dramatically. I'm sure Josh has some thoughts, on that too, but that's probably the biggest impact that could have. And also, if we do move fast to a $15 minimum wage, a lot of small manufacturers that are labor intensive, really, can't raise prices like, at McDonald's on a Happy Meal. So they don't have that luxury so they get squeezed. And so we're a little bit concerned. I can think of several of my clients that would be a very big impact from where they're at. Another reason why that is we see this continued consolidation and continued move to sustainability through these options that we've been talking about to accelerate growth. So those are the main, the Cliff Note version of kind of what may keep you up at night.
Yeah. And we've got out on our website, there is a really good comparison side by side of the two different plans. But Josh, Tom's comment about, capital gains rates going from 20 to 40%. What do you think about that? And
I try not to think about it, but I do think that we're going to see a rush, kind of like Tom saying, wealth planning, kind of before the end of the year. I also know of several transactions that are kind of racing to get done before the end of this year, just because there's certainty. I think if the current administration kind of continues on, we'll see continued M&A activity and kind of robustness into next year. If there is a shift in the administration, and especially a sweep, right, where it looks like a tax policy change is going to occur, definitely going to cause a pause in the markets until we know kind of what's really, what that's going to look like. And then I do think there's going to have to be some valuation resets. On the one hand, you have sellers who are going to have to pay a lot more to Uncle Sam than kind of what they're putting in their pockets. So they're going to be looking to get an increased price for their business. Whereas on the other hand, a private equity buyer or really anyone as the next owner of the business is going to have to pay potentially higher minimum wage, potentially higher kind of taxes if it's set up as a corporation, right? Having corporate income taxes go to 28%, right? So it's really kind of sets up for a diversion in valuation, whereas sellers are now wanting more and buyers have kind of an unwillingness to pay what they were in 2020. So, kind of all of that together, there still is, a lot of capital sitting on the sidelines. Interest rates are expected to remain relatively low for a period of time, and there's a lot of firms whose businesses are established on getting deals done. So I think we'll find our way to kind of that convergence point, but there is definitely going to be a lot of challenges kind of coming up with the right valuation in the new environment, especially we're not going to know January 20th or 21st exactly what that's going to look like likely. Mm-hmm. So I think there's going to, this uncertainty period is likely going to create a bit of a stalemate for a period of time until we really know what it's going to look like. Is it going to go back to, is it going to be retroactive to January 1st? Is it going to be go forward? Do we have a period of time to get deals done? So I think there will be a bit of a pause and kind of a wait and see to figure out kind of what is the new normal, and then how do we operate in the new normal.
Blake, any thoughts in the banking markets, about the election impact? Anything that you foresee or you're thinking of?
Yeah, I mean, absolutely. I think Josh just touched on some of that, but certainly we're definitely seeing a lot of companies that are trying to get their deals done before 12/31, whether it's fear of a day one tax increase or kind of retro back to 1/1. So I'll try to answer this like a Republican and keep it specific to lending, but I think we've all seen there's just been limited oxygen in this room, and it's been sucked out by politics in the past, I don't know, months, right? It gets complicated pretty quick. I think, who controls the House, et cetera. Just a real quick brief history. Back in 2010, Obama signs Dodd-Frank, which 848 pages, 50 pages, which turned into 8,000 plus pages of rules and regulations. You can't make this stuff up, but it drove banking policy and frustrated the heck out of both bankers and borrowers alike. Fast forward, these policies, I think ultimately drove part of our industry and the use of private credit, which we touched on a bit. I think Trump, it was interesting. I read an article I'd forgotten about, but within literally a few days of Trump going into office, he signed an executive order. It required regulators to revoke 2 rules for every new guideline created. And did this to manage costs and really free up the flow of capital. So, it's going to be unique because Biden is annoyed by this. He spent a good chunk of his administration pouring time, energy, and effort into Dodd-Frank. It was designed to curb negligent lending. And he's campaigning actually on that promise again, is to reinstate these financial reforms. So, I think unfortunately a lot of that comes at the cost for financial institutions. At the end of the day, though, we're in an interesting spot because reality will always kick in. I mean, short term, I don't think there's going to be a ton of policy movement at all, just because we are in the middle of a pandemic and a recession. So I don't think it's going to be a day one agenda for either one of them, and I don't think we're going to see wholesale changes to lending. I would have to say over the course of hundreds of years, though, we put our money into banks. Government guarantees that we'll get it back. The banking system is simply not designed to take really meaningful risk. So, I think that the outcome as to whoever's in the White House, I don't think it's going to dramatically change the way that banks act and approach deals on a daily basis. It might frustrate the heck out of the way bankers have to approach their job and see new regulations. Or it might ease up on a little bit with less regulations. At the end of the day, I think, if I had to go right at it, Trump, not a ton of change. Biden, maybe some negative change to our world. Maybe not dramatic changes to the banking market, but certainly some politicians that are out there. Josh can probably elaborate on this. Elizabeth Warren, Senator in Massachusetts. She's definitely talking and has talked a pretty big game about regulating private equity and potentially private debt. It's a long way off, maybe a little bit too early on that one. But Josh, do you have any thoughts on that regulatory piece of it, private equity?
Yeah, I think it's still too early to kind of tell, right? And I would say we'd be hypothesizing at this point. But the capital gains tax, I mean, having private equity firms, when they're basing their returns analysis, it's a private, it's a capital gains kind of 20%, obviously less than ordinary income world, and all of that is factored in, right? You can't, in a new environment, pay the same price for a business and get the same after-tax returns, right? So it is, that alone is changing. And then, there have been a lot of folks looking at, should private equity even really get capital gains treatment for money that they're not technically putting into a business, but realizing the benefit of those appreciation of value. So a lot of talk. It's been going on for 15, 20 years, right? So I think your guess is as good as mine is where we're going to end up 5 or 10 years from now.
Got another question here that probably goes to Josh and to Ryan. Since Ryan, I know you're looking at some acquisitions, and Josh, you're certainly in the market too. The question is that some feel that selling a company today would generate very discounted offers in this COVID impaired environment. So do you agree that buyers can still get a fair valuation, or do you think that all deals are distressed right now? Ryan, any thoughts?
I think that to start with, from our perspective, one, in our new reality, what we pay for a business is public information, so it sort of sets the expectation for the next seller. Every deal is different, but we've got kind of a range that they're expecting. We think of COVID as a point in time. We're still underwriting the businesses based on what we can project in terms of cash flows and growth in the business. So we're not really looking at it that way. And our counterparties have not gotten a haircut on valuation. We've been pretty forgiving in looking at the short-term impact of COVID and trying to normalize what the real run rate is of the business.
Yeah, Steve, I think their valuation is difficult in today's environment, but we're also, like Ryan, right, kind of view COVID as a point in time. For me, kind of being specifically in the auto industry, and I know this is happening in other industries. Volumes were horrific in the second quarter. They came back incredibly strong July, August, September, and October. And I think the big question out there is that sustainable, right? We're kind of in a perfect storm, right? So we had kind of the perfect storm in COVID where everything was shut down, and now we've got kind of this build back up where you had folks getting enhanced unemployment, stimulus checks, dealers were closed, inventories started to get depleted. So now we're kind of in a different perfect storm of inflated volumes, and what is the right kind of normalized level, right? So very conveniently, sellers will point to the fact that July, August, and September were above their original budgets and were above what they did last year. But if you look at longer term forecasting, a lot of the industry experts are saying it's not sustainable. So I would say, I'm very quick to kind of forgive the COVID piece of that, but it's really, and I would say kind of as a result, not looking at a discounted valuation, but what is the right normalized level, right? Are we truly back to 2019 levels? I mean, if you look at the third quarter, we are, but is that sustainable? And then I think the other factor for groups like mine are, what does the lending market support, right? Whereas we could pay up for a business and take on a certain amount of risk by filling out that capital structure, getting really cheap financing kind of back in 2019 and early 2020. That's no longer there, right? Interest rates have gone up, terms have changed around a bit. So, and then those lenders also, while we may be quick to forgive as an equity investor because we're buying future earnings, a debt partner is a little bit more stringent on kind of sustainability of cash flows and doesn't have, I would say, as long of a horizon as we do. So there are a lot of things coming together. I would say, for the person that asked, is it all discounts out in the market? I'm with Ryan. I would say no.
Yeah. No, the only thing I'd add to that, first of all, I agree with what you're saying. I think that a lot of the deals we're seeing, that people are looking at this as an episode, and there's going to be a recovery from the episode. It's how quickly do you recover? And the other thing I'd say is our quality of earnings team is insanely busy right now. So to me, that's sort of an indication that there's going to be an active deal market. Whether that, I don't think that's not necessarily an indication that all these deals are closing before December 31st. These are deals that are slated to close in Q1 and Q2. So, there's still a fairly robust deal market, and guys like Josh have money to spend. They got to put it to work, and, they've got limited, fund life. And, the mission of a lot of private equity sponsors is to get from fund 1 to fund 2 to fund 3. So you need to have success and you need to deploy capital. Tom,
Steve,
maybe a question.
There really was no deals getting done in the second quarter, right? The capital is still there to do those deals, but you took a big chunk out of the year where no deals were getting done. So, I think there will be, there's a lot of pent-up demand to get deals done, right? A private equity firm that's not doing deals isn't a good thing. So, you kind of sit here and scratch your head if it's been 6 months now and you haven't gotten a deal done. You start to get anxious, and maybe you'll push the envelope on valuation a bit to get that next deal done, which I think bodes well for sellers that kind of are looking to come to market at this point.
I'm mindful of time here. I got just a couple more questions I would like to try to get to. Tom, just when you think about businesses that you've seen throughout our client base that have outperformed actually during this pandemic. So we talk about V-shaped recoveries, U-shaped recoveries, but there's actually some that have done fairly well. Any characteristics that you happen to note on businesses like that?
Yeah, there's definitely, you can see there's been, some winners and there's been some losers, but, it really comes down to is, a strong diversified customer base in our markets. That is critical. Of course, what we talked about is that strong balance sheet, the ability to withstand, even when we do, projections and modelings for like, what does a business look like? Can it withstand a 20% drop? Can it withstand losing a customer or two, right? So those are big things that we see that, where there's a, handful, companies that we're working with where we're trying to get them out of that risk zone, right? whether they are too concentrated in a market or a customer. And obviously, something we've been preaching is those companies that have made big investments in talent and technology and innovation are just leading out of this charge. I mean, innovation is something that, is very, passionate in our, we've been talking about for many years, and we feel that that's going to be even more critical. You look at a pandemic, it just kind of says, boom, the future is now, as far as technology, and that scale, right? We talked about, having enough scale to be able to withstand that downturn. And ultimately, these are times, you've probably heard it as cliche is don't waste a good crisis, but these are times when we have clients that are out looking for deals. Those that have liquidity, there's no doubt about it. This is an opportune time, to either be a consolidator or potentially are you a target for consolidation. So I think those are some key characteristics that we see that have really, we've seen some clients that just accelerate through this, whether they were deemed a critical supplier, essential supplier. They were creative in whether it was pivoting and creating, personal protective, gear. So you have to be able to, really challenge the organization to be successful.
Well, it's a great point, and Ryan got one here about going public. Do you think going public is attainable, for more middle market companies, and is it something that they should be considering? Anything that you want to share from your experience through the process?
Sure. So we were talking about it before the panel started today, just sort of the how the listings, the SEC registrants have dropped over the last 20 years or so. And I think we're going to see a reversal of the trend. One of the things, when we merged with the SPAC to go public last February, there were, I think, 60 or 70 SPACs that were trading, and today there are over 300, I heard, recently. So there's just a tremendous amount of liquidity that are out there looking for good businesses. One of the things about the SPAC, vehicle in particular, is there's a tendency that these businesses underperform, and I think it's partly selection. They have a wick burning, and they've got a certain amount of time to deploy the capital, and so they're racing to buy companies. And I think that one of the most important things is to be ready to be public, and we really did this quickly. We got ready to go public in less than 8 months. But I think it's a year-plus process if you do it at a normal pace, and that to me is kind of the gating thing, is being ready to be public, the quality of the finance and accounting team, ready for doing public earnings calls and announcements, and just UHY has helped us tremendously in preparing for that over the last several years, including the chapter where we had the mezz debt. So I think absolutely more small, mid-market companies should be going public. It's a great tool. It's a great source of liquidity. And, I think that the preparation is the most important component to the success of it.
Well, thank you very much. I certainly appreciate this. We're certainly in a crazy world with stock market volatility. There's the COVID risks, the political uncertainty, and there's even a hurricane hitting down south. So you name it, I think anything's possible this year. And but Tom Alonji made a great point, about having a strategic plan, and I think that the panelists that are here today, each of them have a vision and a plan of what they want to accomplish and what they want to grow. And I always talk to business owners about, this isn't an audition. If you don't have a plan, you just got a really risky job. So it's really critical that you really think about where you want to get to, what your goals and objectives are. And I know at UHY, those are the conversations we want to have with clients. We want to understand what the objective is. How can we structure the business to reach that and take care of your family along the way? So Tom, I'd like to turn it back to you for maybe some concluding thoughts.
Yeah, I'm just gonna conclude on, again, just share my, really what we think are some of the key drivers to accelerate growth that we've talked about, and that setting that strategy, it's hard, it's difficult, it's painful, but you got to do it. And then you have to decide, do you have the ability to build scale, buy scale, partner up with a private equity, potentially go public, but build that strong balance sheet that allows you to attract, retain talent. And obviously, what I still feel is most important as we look to the future of our middle market is to be able to invest in innovation and technology. You call it Industry 4.0, internet, whatever you want. There's lots of different pieces of that puzzle that manufacturers need to embrace to be successful in the future. So really, I want to thank everybody, our panel. Steve, thank you for moderating. And again, if you have any questions, feel free to reach out. Our goal was really, to turn this what feels like a very negative situation right now, obviously with pandemic and COVID rising, but we will, this too shall pass, and we will see a brighter future. And so we just want to make sure you see some opportunities of how you can sustain your business.
Awesome. Thank you all. I really appreciate your time today. It was a great panel. Thank you again.
Thank you.
And Tom.
Thank you, Tom.
Thanks, Tom.